Tesla stock is the first stock we're going to talk about in today's video. I want to go ahead and react to this video from Farzad. Tesla investors just got scammed. The stock's down massively here today, down about 7.5 percentage points. We're talking about an epic loss of market capitalization here today on the back of some legal related news. So we're going to get into that. I want to share my opinions and perspectives in that video. Then we're going to go ahead and react to this one. I went ahead and I took off all my Apple hedges today. So I'm no longer hedged against Apple as of right now. So I want to go ahead and hear why Apple should be in your portfolio. That should be interesting. Then I want to hear why Dr. Doom is less worried than in the past. Okay, you got a name like Dr. Doom, you always should be worried, right? And then last one up here is this little one from Bloomberg. Markets are approaching a little euphoria. Okay, that one should be intriguing to get into. So appreciate everybody joining me as always. I'll ask in return, smash a like, hit the subscribe button, folks. We're at a new all-time high. Also have a brand new workshop for you guys. That's pinned comment down there, how much money you need to retire. A lot of you guys got a lot of value out of that one. I recorded that one before I got sick, which, man, my health deteriorated bad this weekend. I was not expecting that. I was expecting to get better this weekend, and I got a lot worse. So, yeah, good news is today I'm out of bed and doing okay, but I mean, my gosh, it was a rough weekend for me. So we're making it, though, man. We're making it. Alrighty, so let's go ahead and get into this.
This one brief. If you follow the Tesla story closely with Elon Musk, you know that about a month ago, a judge in Delaware rescinded Elon's $56 billion comp package that was put in place roughly 5 to 6 years ago, which basically means that investors have to vote on that package again. Now, today, March 1st, 2024, there is news that the lawyers that won that claim that $56 billion comp package essentially needed to be rescinded, needed to be voted on again. These folks want a $6 billion fee for winning the case. So I'm going to try to make this brief because this is weird. I want to get your opinion in the comment section below. Let me know if I'm overreacting to this. I would love to hear your opinion. But what I find really interesting is that you have a person that brought forward a suit with the intent to protect investors. That $56 billion comp package that Elon Musk received, that investors voted yes on, the thought process was like, hey, he's overpaid. This is way too much. This is at the detriment of the investors, of the Tesla investors. This is bad. Even though with the years that went after that comp package was voted on, the stock price went up 10x, 20x, whatever that number was. A bunch of investors made a bunch of money that invested before that period, including the person that had the 9 shares that brought the suit forward. And so the thought process was, we're protecting investors by ensuring that Elon's comp package is more transparent. And now the same exact lawyers that are claiming to protect Tesla investors by rescinding the CEO's comp package, those same lawyers want to be paid $6 billion for their efforts, which most likely the Tesla investor will have to pay for those lawyers, right? Those lawyers, they rescinded the comp package. Congratulations, we saved you a bunch of money, supposedly. And so now these lawyers are like, hey, we deserve $6 billion for our efforts. We want $6 billion. Okay, so in the likely scenario that this ruling...
Now, if you're wondering, how much of Tesla's cash is that? From what I remember, in the last quarter, Tesla reported of their cash only, not if you combine it with investments, short-term investments, things like that, their cash only, if I recall, was about $16.9 billion. And so that would take them down to about $10 billion of cash, somewhere like that, right? Which is the lawyers taking just an insanely epic fee. I mean, that's, even by legal standards, that's insane. And one thing I'll say about this is a risk of, if you want to get the government more involved in things, lawyers more involved with things, this is a risk, you're going to have to take. I see a lot of people all the time like, oh, the state should do this, or the city should do this, or federal government needs to do this. And I see a lot of that. And I'm like, okay, you're got to understand there's going to be a lot of stuff that's going to make you really mad. The more and more you let the government and these folks interfere with things that are going on in private business, the more and more you're going to end up into a situation where ultimately long term you'll probably end up hating the situation that you got yourself into. You thought it was going to make it better by getting more legal involved, by getting more government involved, and then you wind up and you're like, oh my gosh, this is actually way worse than if we just let the free market be the free market. So that's all I'm going to warn people about. I see it all the time on social media. People get everybody all excited, and then people are clamping down saying, oh, government needs to do something, this person needs to do something, and then and now look at this, government's got involved, right? Judge makes a decision here, and what?
The unlikely scenario, whatever you think, whichever camp you're in, if this ruling stands, what's probably going to happen is shareholders will vote again on a comp package, on the same exact comp package, which I'm going to guess they're going to vote yes to again, for Elon to receive the $56 billion, which will change basically nothing for Tesla. But if this stands the way it does right now, then Tesla would be out an additional $6 billion to pay these lawyers. And these lawyers brought a suit forward with the intention to protect Tesla shareholders. And it doesn't seem like they are protecting Tesla shareholders when the outcome of this entire thing is going to be Tesla is just going to be out $6 billion to pay for the lawyers that supposedly are protecting Tesla investors. I personally feel like this is extremely wrong. It rubs me the wrong way. If they're really looking after Tesla investors, why are you looking for a $6 billion fee? What are you achieving with that number? Especially when a revote hasn't happened, or with, especially since the whole thing hasn't been dealt with yet. You don't even know if this is going to stand. Why are you asking for $6 billion, right? I don't understand that point. So help me understand in the comment section below. Let me know how you feel. I think this is I'm trying very hard to not feel like this is extremely corrupt, but you tell me. You tell me. All right. I hope you have a fantastic weekend. Bye, funny. Everybody.
Thank you for that, Farzad. I appreciate that. Oh, yeah. Oh, yeah, baby. Welcome to the real world. All right. Next one up here. Here's why Apple should be in your portfolio.
Feel optimistic. Is this something that you say, okay, well, I'm going to continue to be a shareholder over the medium and longer term?
Well, I think it's how do you define what Apple is? We know that they're not a business software developer like Microsoft, and they do develop their own chips, but it's not necessarily in the hot area, AI. So what are they, and why should they be in your portfolio? Well, they are the supplier of the platform that gets a whole lot of eyeballs onto things that run AI. And are they going to be displaced anytime soon? And I think the answer is no. One of the reasons why I continue to own this is their unbelievably strong moat. Once you become a user, try not to become a user, right? So they absolutely need to step up their game in iPhone and any of their devices, because they are a device maker, not a software maker. And they need to be the platform of choice to get it into the hands of the consumer. Maybe into enterprise, but mostly into the consumer. And that is why they continue to be in our portfolios.
Kim, why do you think, or as an Apple shareholder, maybe I'll frame it differently, they are shutting down their car ambitions and they're going to shift resources to artificial intelligence? We heard that. They've said it for the record. Are you okay, happier, less happy, sad about the fact that cars are no longer part of the equation and that the resources are going to go towards AI, or not?
I'm thrilled. I don't know why they were in the car making area anyhow, because a lot of it is on batteries. Yes, I get that, and electric motors, but mostly it's in, all car stuff. And I don't think Apple had a whole lot of knowledge about that. And maybe we would have had the prettiest looking car or whatever, most aesthetically pleasing car ever in the history of the world. But as an Apple shareholder, I really didn't care. I'm glad they're back to understanding what they do. And this feels very Microsoft, I don't know, maybe 2014, when they stopped chasing Apple, when Microsoft no longer wanted to develop a phone. And they just understood where their role was in the world, and that is as an enterprise software company. And I feel gratified that Apple is leaving the world of EVs behind and concentrating on what it does best.
That's fair. That's fair. No objection there. The one thing I'll say about Apple, take a peek at the stock here today. It's been down anywhere 2 to 3%, and something strange is going on there, right? What is going on? So here we have the NASDAQ doing pretty good, S&P 500 doing really good. Those are right around all-time highs. And Apple just continues to show weakness and weakness and weakness. And we know there's consistent week in and week out buying S&P 500, which obviously where does the majority of that money go? It goes into Microsoft and Apple. We know there's always consistent QQQs buying out there. Where does the majority of that money go? It goes into Microsoft and Apple. And so to see Apple so weak like this, and we know Apple's always buying back massive amounts of their shares, to see the stock so weak, it makes you have to ask who's consistently selling the stock day in and day out. And I just have to wonder, is Buffett selling? Like, I just have to wonder, like, is he dumping a position? Because, you know, he sold shares last quarter, and it didn't even make sense why he would sell unless he just wanted out of the stock. And then, like, to see the stock continue to move down, even in this market that has been pretty good, you got to stiffen that out and be like, well, there's got to be a big seller. You know, if the whole S&P 500 was tanking right now and the Qs were all tanking and Apple's going down with it, at that point you can understand, okay, it's just the market. We're just in that sort of market. But when everything else seems to be doing just fine, and yet Apple continues to just have a tough year, there's something fishy going on there. I mean, you know, if we pull up Apple and we go to this baby and we go year to date, you know, down over 5% year to date, and you look at its peers are doing phenomenal outside of maybe like Google McDougal, that's just, you know, fishy. So I don't know. We'll find out, you know, in a few months if Buffett is indeed actually selling more shares of Apple, but it's very strange. So hear what Dr. Doom has to say.
Noriel, good morning to you, sir.
Good morning, John.
It's good to see you. I was reading through some of your work, and I have to say, it didn't seem like you were worried about too much in this economy, in this market. Is that right?
Well, I'm less worried than the past. I think a year ago, people were worried about a hard landing. Then they started talking about the softish landing with a short and shallow recession. Now people talk about a soft landing, but there is serious possibility of what people refer to as a no landing, that growth remains above potential, and inflation remains sticky. And actually, of all scenarios, the one that is more risky for the market compared to a soft landing is a no landing, because markets were pricing in 6 rates cut by the Fed earlier this year. Now they converge to what the Fed is telling us, only 3 cuts. But what if growth is well above potential because of technology or other factors, and then the Fed doesn't cut 3 times, only 2 or 1, maybe some people say 0. Last year, revisions of expectation about the Fed in August and September led to a 10% correction of equity. So I think that's potentially, paradoxically, that good news on growth, maybe bad news for the market, if that implies the Fed is not going to cut as much and as soon as people expect now.
So just to put it in a headline, Nouriel Roubini thinks the biggest risk is upside risk.
Right now, yes, because the data on Q4 suggests the growth well above potential, and even Q1 suggests that maybe growth is going to be around 3% plus. We're not having a landing of the economy in spite of the Fed cutting rates.
So just to put another headline in this, even Nouriel Roubini is optimistic. I mean, we're looking right now, people looking for reasons to kind of gut check.
Well, let's be clear about this in regards to this man, okay? He's kind of being optimistic and pessimistic all at the same time. It sounds like, if anything, he's a little optimistic short term, right? Numbers can come in better than expected, and the Fed doesn't have to cut as much or as fast, but that could potentially lead to problems in the market, right? Where the market looks out there and they say, oh my gosh, wait, the Fed's not cutting. We thought the Fed was going to cut 4 times, 6 times, however many times this year, right? And, you know, it's just, the can might be kicked down the road a little bit here in regards to cuts. But we'll see. I mean, inflation numbers are looking pretty good. You look at the Truflation data, it's looking very, very good. You look at commodities. What are commodities doing? Let's see what commodities are doing year to date, or a 1 year, right? Because that's what's relevant. Let's see what commodities are doing on a 1 year. So oats are up 13% on a 1 year. Corn's down about 35% on a 1 year. Soybeans down 25% on a 1 year. Silver's kind of irrelevant there. Coffee's up about 3% on a 1 year. Lumber, 53% up. Oh my gosh, that's not good for real estate. In terms of pricing, it's good for pricing if you want pricing to be up, but it's bad for inflationary numbers for real estate. I'll put it like that, okay? Wheat down 20%. Man, this is an interesting commodities market. 3% down copper. If we look at UCO, it's up about almost 6%, and then WTI on a 1 year is up about 5%. Natural gas is down 51% on a 1 year. What a weird bunch of commodities. And so net commodities are up 2% in the past year. That's great. That's really good. If we could have commodities only go up 2% as a basket each year, we're looking really flipping flapjack and good here. So, but very, very strange. I mean, it's just strange how some of these commodities are rolling and then others are just getting destroyed. Like the soybean move, but then you got lumber up 50% nearly. I mean, that's wild. So anyways, crazy markets. But my goodness, let me pull back up big tech here so we can watch that as we finish out this video here. Man, commodities. So anyways, the moral of the story is inflation's still looking pretty good. If commodities go on another big bull run, we're screwed.
A runaway record rally that we've never really seen in this kind of environment. And the gut checks aren't coming. Does that sort of give you pause, or is this basically a new paradigm where the artificial intelligence and the whole idea of productivity, that you're buying it?
Well, there are several things. First of all, last couple of years, inflation fell without growth slowing down sharply, in spite of the Fed tightening rates. And in my view, not because of what the Fed does that push inflation lower. We got lucky because there were 3 negative aggregate supply shocks post-COVID that led to lower growth and higher inflation, and they were reversed. The impact of COVID on labor supply and production of goods and services, the impact of the Russian invasion of Ukraine on commodity prices, and the zero COVID policy of China. These were negative supply shocks that were reducing growth, increasing inflation. Those went away, and that explains why you had still high growth and lower inflation. So it was not the Fed job that did it. It was just we got lucky. And on top of these 3 positive aggregate supply shocks, now we have a 4th one that is actually much bigger and secular. This is the AI revolution, this technology revolution that probably over the next decade, not this year, is going to increase productivity growth, is going to increase potential growth, is going to increase economic welfare, and is going to reduce cost of production. So I think that's what the market is reacting to.
That's fair. And yeah, I think the good point he makes right there is, I hope you guys picked up on that, right? He said over the next decade, maybe not the next year. Everybody wants all this productivity and all these gains for the economy. It all happen like right now. And it's like, this is a process. Like it's going to, it takes a while, for all these big mega trends to catch on and then actually start to matter significantly out there. Markets are approaching a little euphoria.
The NVIDIAs of this world, the top performers of the last 12 months?
Yeah, I think you can certainly lighten up your equity exposure overall. I mean, I would take it first from small cap, which has been, a relative underperformer, battered and bruised. But I think you do have to lighten up. If you
lighten up in small cap, then it's just an incredibly bearish stance. Yeah, it's just very bearish. It's not like small caps have done anything amazing. You know what I mean? Like let's pull up smalls in the past year. I'll just search it here. IWM. Let's see. So let's pull up a 1 year here. IWM. 9.5% in the past year. That's very average performance for the IWM on a 1 year basis, right? On a 5 year basis, IWM is up a whopping 36%. Yeah, that's just, it's just a very bearish view to say lighten up on small caps. That's all I'll say about that. Extremely bearish. Extremely bearish.
Enjoyed 24% return over the last 4 months, which is what you've gotten November, December, January, February, 4 months, right? That is impressive. You'd be wise to take a little profit there.
Yeah, but I can also point out specific time periods. Well, over the last 8 months, IWM's only done this, and we can all play that game. That's a silly game to play.
Conversation you were having earlier. Remember and recall, sage words, wisdom says bull markets die in euphoria, right? To the point, there is no downside that anybody sees at this point. We are starting to approach a little bit of euphoria here, and I think you have to set that context correctly.
Let's get into that word, okay. Euphoria. So Savita Subramanian's come out over at Bank of America. She's gone to 5,400 from 5K. She says any signs of euphoria are thematic and secular. So we're talking about AI, NVIDIA, we're talking about GLP-1s, we're talking about Novo Nordisk. Outside of that, where are you seeing what you would describe as euphoria?
I think you're seeing it in, well, you're definitely seeing it in technology. You're definitely seeing it in consumer discretionary. You're definitely seeing it in comm services. All the leaders that have continued to lead. For markets to really make that next leg higher, you've got to have three things happen, right? You've got to
hold on. Before he goes further here, are we really seeing it in technology? He says we're seeing it in technology, right? Let's pull up. Let's pull up some year to dates on some of these stocks and really see what's going on here, right? So Tesla year to date down 24%. Snowflake year to date is down 6%, right? 6%. Google McDougal about 4% year to date. Apple over 5% year to date. PayPal 2.6%. Shopify is up 2%. Palo Alto Networks up about 4%. Adobe's down 2%. Obviously, Meta's been smoking. Meta's been a beast. Netflix has been a beast. Microsoft's had a pretty good start to the year. Salesforce has had a great start to the year. Amazon's had a great start to the year. Intuit as well. Oracle as well. Oobity Booba. MU has had a great start to the year. And then obviously chip names, NVIDIA, AMD, all those guys, right? So what that looks like to me is that's a haves and have-nots market, right? Where you have certain stocks that are just absolutely doing horrible, in that big tech, that Mag 7, and then you got other stocks that are looking like, man, things are great. We're up 10%, 20%, 30% already this year. So you got a divergence in regards to tech even.
Breadth widen out, right? Narrow markets die painful deaths, right? I mean, 2023 was the narrowest market only to 2007. We know what happened in 2008, right? And if you go back and look at other narrow markets, 2020, 1999, 2021. Remember 2021 to 2022, what happened in 22? Big negative returns. What happened in 1999, in 2000, right? So narrow markets don't sustain that leadership. History teaches you that lesson over and over again. So you need breadth to widen out. You need earnings to participate. Better fourth quarter numbers, right? We'll take the earnings growth. But think about it this way. If companies, even large cap companies, if their wages are still growing 4, 5, 6%, right? But their top line, we just saw the total sales number grow at 3, let's call it. I can't have my biggest expense line as a company CEO or CFO growing at 4 or 5% and my top line growing at 3 without starting to lay people off, without starting to roll the economy over in that sense.
Yeah, that's fair. That's fair. I can't debate that, okay? I appreciate you guys joining me. As always, thanks so much for being here. Get my free workshop. I filmed that when I was still doing well. That's pinned comment down there. It's absolutely free to access that. How much money you need to quit your job, retire, all that good stuff. It's a really good workshop there. Much love and have a great day.